Investing $1,000 can substantially boost wealth, but success hinges on strategy. Whether a one-time investment or part of a consistent plan influences outcomes. A single investment may yield returns, but ongoing contributions enhance potential growth. Strategic, informed decisions align with long-term financial goals, maximizing the impact of the initial $1,000 and paving the way for sustained wealth accumulation. Regularly reassessing and adjusting the investment approach ensures adaptability in the dynamic financial landscape, crucial for lasting prosperity. In this video, let's find out this magical investment strategy. Let's first consider the scenario where you only have $1,000 to invest, intending to let it grow over the next 10 years. Historically, the average annual returns have been around 50%, surpassing benchmarks like the Dow Jones by a significant margin. It's essential to note that these returns were based on a small initial investment. If you've saved up $1,000 and are contemplating investing it in the stock market or riskier assets, congratulations on taking that step. However, there may be better ideas than putting this money in the stock market if it's your only $1,000 for a while. To illustrate, imagine the stock market experiencing a major upswing, providing a 25% return in a year, 15% above the average. While professional investors may celebrate, your $1,000 would only yield a $250 return. A significant return, but perhaps not transformative for your financial situation. Some argue that a safer option is a savings account or a certificate of deposit or CD due to guaranteed returns. As of February 2023, the average return through a savings account is a mere 0.33%, resulting in a net total of $1,106 after 5 years. CDs with an average rate of 1.37% for a 5-year term would grow your $1,000 to a modest $1,068, which may not be worth the 5-year wait. Even if you were to invest in the stock market with an average return of 7% over 5 years, you'd end up with $1,400, better than the previous options, but still not a life-changing amount. Relax, no need to worry. There is a smarter move you can make to grow your wealth. Invest in yourself. According to Warren Buffett, the best investment you can make is in your own skills. Expand your knowledge by reading books, attending webinars, joining seminars, or taking courses. This makes you more valuable to employers. Learning skills such as marketing and coding can open up opportunities in various industries. Follow Charlie Munger's advice to become a lifelong learner. Read extensively, nurture your curiosity, and strive to become a bit wiser each day. The more you learn, the more you'll grow, leading to increased financial and personal satisfaction. If you have $1,000, consider creating another income source. Thanks to the internet, it's now easier than ever to generate additional income. Invest in your knowledge, take action, create something, and use the money you earn to further invest in your business or the stock market. Whether you have $1,000 or more, consistently invest in your education and skills. Explore opportunities to create additional income for long-term financial growth. Look for passive income options to let your money work for you while you continue earning. Warren Buffett emphasizes the importance of making your money work for you with a powerful quote. If you don't find a way to make money while you sleep, you will work until you die. And who wants to work their whole lives? Probably not many. Now, the most common way to achieve passive income is through the stock market. However, when I say stock market, I don't mean picking individual companies like Tesla or IBM. Instead, consider investing in index funds, which offer a diversified approach and reduce the risk associated with individual stocks. Warren Buffett, who strongly supports this approach, offers an example to explain it further. Imagine putting all your money into Tesla. Unfortunately, there's a problem with the car batteries in the latest models. They stop charging without a clear solution. This leaves many people unable to drive, leading to potential accidents. To make matters worse, fixing the issue requires replacing the entire car, which Tesla can't afford. Lawsuits pile up and the company goes bankrupt. Your investment in Tesla is now worthless, even though it's not your fault. On the flip side, if Tesla develops a groundbreaking battery that charges faster and offers double the range, your investment could double and the upward trend might continue. Investing in individual companies can bring significant returns, but it's also riskier. If you make the wrong choice, you could lose everything. A practical guideline is that if you lack the time to study companies and understand investing, it's best to steer clear of individual stocks. This is where index funds come in. They're like a collection of different companies bundled together, eliminating the need to pick specific winners. You can invest in the overall market, a specific industry like tech, or even companies that pay dividends. The great thing is that buying index funds is as straightforward as purchasing individual stocks. However, it's important to note that investing, even in index funds, doesn't guarantee profits. Always do your research and don't blindly follow advice. The examples provided are just starting points for potential investments. And before I proceed any further, I'd like to invite you to hit the like button, subscribe for more financial knowledge, and don't forget to turn on notifications to get more important financial updates from me. You have a couple of good options for investing your money. If you're looking for a safe and reliable choice, consider general market funds. They're great for beginners. Two popular options are VU and SPY, both giving you exposure to the top 500 US companies. These funds tend to rise with the US economy and fall when it goes down. If you're interested in the tech sector, VGT or QQQ are good choices, exposing you to companies like Microsoft, AMD, and Google. Each fund has different companies, so do some research to find what suits you. For those wanting dividend payouts, VYM or SDY are worth considering. Investing in these funds provides exposure to companies that pay you for investing in them. To maximize your investment, allocate a portion of your paycheck, around 10 to 15%, directly into your account. This prevents accidental spending of money intended for investing, a strategy Warren Buffett famously endorsed. Do not save what is left after spending, but spend what is left after saving. Another way to invest your $1,000 is through real estate. While it might not be enough to buy a rental property, you can explore options online. Crowdfunding real estate platforms, for instance, allow you to pool your $1,000 with other investors to fund real estate projects. If the real estate venture succeeds, so do you. And if the property value rises, your returns increase as well. These platforms mainly generate income through rent, but it's crucial to understand that the money you earn isn't readily available. Unlike stocks, selling a property takes time and effort due to the physical nature of real estate. If you're comfortable with investing in real estate, lack the funds to buy your own property, and are okay with not accessing your money immediately, this could be a suitable option. Alternatively, you can directly invest in real estate through real estate investment trusts or REITs. With REITs, you invest in a company that deals with real estate but functions similarly. You receive dividends from rental income and other sales without being directly involved in property ownership. REITs often offer higher dividends as they are required to distribute 90% of profits to shareholders. Examples of REITs include VNQ and USRT. If investing isn't your preference, consider paying down your debt quickly. Accumulating debt at high interest rates like 18 or 20% hinders financial progress. On the other hand, lending money at such rates can be lucrative if you find trustworthy borrowers. However, it's better to be on the side that isn't constantly playing catch-up in life. Paying off debt early can be seen as a return on investment. For instance, with a 4% interest rate loan, like a car loan or student loan, paying it off a year early effectively yields a 4% return, as you save on a year's worth of interest payments. If you're hesitant to invest in stocks or real estate, focusing on paying off debt quickly is a practical alternative. It increases your available cash by reducing monthly expenses, and the sooner you eliminate debt, the less interest you'll pay, leaving more money in your pockets. Now, I want to hear from you. What investment insights did you find most valuable? Are there specific stocks or sectors you're eyeing? Drop your thoughts in the comments below. And remember, the key to successful investing is continuous learning. If you found this video helpful for your investment strategy and wealth building, I strongly encourage you to watch my other video, Most Powerful Cryptocurrency for Better Investing Options. Wishing you profitable investments in the year ahead. Until next time, happy investing.